Good morning, good afternoon, and good evening. Today we will talk about Chapter 15, Part 3. It is the last part of the book. I hope you learn a lot of the book and start your investing journey. The Malkiel Step. As readers of previous editions know, I like to buy shares in a special type of investment fund called a closed-end fund, officially, a closed-end investment company, when they are available at attractive discounts. Closed-end funds differ from open-end mutual funds, the kind discussed in the preceding section, in that they neither issue nor redeem shares after the initial offering. To buy or sell shares, you have to go to a broker. The price of the shares depends on what other investors are willing to pay for them. However, unlike shares in open-end funds or in ETFs, this price is not necessarily related to net asset value. Thus, a closed-end fund can sell at a premium above or at a discount from its net asset value. During much of the 1970s and at the start of the 1980s, these funds were selling at substantial discounts from their net asset value. Closed-end funds hire professional managers, and their expenses are no higher than those of ordinary mutual funds. So for those who believe in professional investment management, here was a way to buy it at a discount, and I told my readers so. The beauty of buying these highly discounted closed-end funds was that, even if the discounts remained at high levels, investors would still reap extraordinary rewards from their purchase. If you could buy shares at a 25% discount, you would have $4 of asset value on which dividends could be earned for every $3 you invested. So even if the funds just equaled the market return, as believers in the random walk would expect, you would beat the averages. It was like having a $100 savings account paying 5% interest. You deposit $100 and earn $5 interest each year. Only the savings account could be bought at a 25% discount, in other words, for $75. You still got $5 interest, 5% of $100, but because you paid only $75 for the account, your rate of return was 6.67%. 5 divided by 75. Note that this increase in yield was in no way predicated on the discount narrowing. Even if you got only $75 back when you cashed in, you would still have received a big bonus in extra returns while holding the account. The discount on closed-end funds provided a similar bonus. You got your share of dividends from $1 worth of assets, even though you paid only 75 cents. The strategy worked even better than expected. Discounts have narrowed significantly on U.S. closed-end funds. Although the publicity given closed-end funds in my books may have helped to close the discounts, I think the fundamental reason for the narrowing is that our capital markets are reasonably efficient. The market may misvalue assets from time to time, creating temporary inefficiencies. But if there is truly some area of pricing inefficiency that can be discovered by the market and dependably exploited, then value-seeking investors will take advantage of these opportunities and thereby eliminate them. Pricing irregularities may well exist and even persist for periods of time, but the financial laws of gravity will eventually take hold and true value will out. With their discounts for the most part dried up at the time this edition goes to press, most domestic U.S. closed-end funds are no longer an especially attractive investment opportunity. But discounts exist for some international funds, funds investing in emerging markets, and funds investing in municipal bonds. Diversified portfolios of emerging market closed-end funds selling at discounts are a viable and probably a preferable alternative to an emerging market index fund. When discounts of 10% or more exist, it is time to open your wallet to closed-end funds. The table on page 404 lists a few closed-end emerging market funds with their discounts as of mid-2014. Check the discounts when you are ready to invest to determine whether they are greater than 10%. Discounts do vary from week to week. There are also closed-end funds that hold tax-exempt municipal bonds. These funds have tended to sell at discounts at times when investors have been concerned about the creditworthiness of municipal securities. Worries about the indebtedness of Puerto Rico and the Detroit bankruptcy led to lower prices and higher yields for all state and local government securities. Those concerns also led to lower prices and bigger discounts for closed-end municipal bond funds. In 2014, many of these funds sold at discounts of 10% or more, and they provided investors with yields between 6 and 7%. The yield on regular long-term municipal bond funds was between 3.5% and 4% in 2014. The closed-end funds enhanced their yields by using moderate leverage. They borrow monies at very low short-term interest rates to buy higher-yielding long-term bonds. This increases their yields above those of mutual bond funds that do not use leverage. This is not a free lunch. Leverage increases the potential volatility, and thus the riskiness of the closed-end funds. A paradox. Although some emerging market closed-end funds appeared attractive during 2014, domestic funds holding U.S. equities were no longer selling at the bargain basement levels that existed in earlier periods. This illustrates an important paradox about investment advice, as well as the maxim that true values do eventually prevail in the market. There is a fundamental paradox about the usefulness of investment advice concerning specific securities. If the advice reaches enough people and they act on it, knowledge of the advice destroys its usefulness. If everyone knows about a good buy, and everyone rushes in to buy, the price of the good buy will rise until it is no longer a good buy. This is the main logical pillar on which the efficient market theory rests. If the spread of news is unimpeded, prices will react quickly so that they reflect all that is known. This led me to predict in the 1981 edition that favorable discounts would not always be available. I wrote, "I would be very surprised to see the early 1980s levels of discounts perpetuate themselves indefinitely. For the same reason, I am skeptical that any simple popular investment techniques will be persistently successful." I have recounted the story of the finance professor and his students who spotted a $100 bill lying on the street. If it was really a $100 bill, the professor reasoned out loud, someone would have already picked it up. Fortunately, the students were skeptical, not only of Wall Street professionals but also of learned professors, and so they picked up the money. Clearly, there is considerable logic to the finance professor's position. In markets where intelligent people are searching for value, it is unlikely that people will perpetually leave $100 bills around ready for the taking. But history tells us that unexploited opportunities do exist from time to time, as do periods of speculative excess pricing. We know of Dutchmen paying astronomical prices for tulip bulbs, of Englishmen splurging on the most improbable bubbles, and of modern institutional fund managers who convinced themselves that some internet stocks were so unlike any other that any price was reasonable. And when investors were overcome with pessimism, real fundamental investment opportunities such as closed-end funds were passed by. Yet eventually, excessive valuations were corrected and investors did snatch up the bargain closed-end funds. Perhaps the finance professor's advice should have been, "You had better pick up that $100 bill quickly because if it's really there, someone else will surely take it." It is in this sense that I consider myself a random walker. I am convinced that true value will out, but from time to time it doesn't surprise me that anomalies do exist. There may be some $100 bills around at times, and I'll certainly interrupt my random walk to stoop and pick them up. Investment advisors. If you follow the recommendations in this book carefully, you really don't need an investment advisor. Unless you have a variety of tax complications or legal issues, you should be able to accomplish the diversification required and do the rebalancing yourself. You might even find that it is fun to be able to take complete charge of your investment program. The problem with investment advisors is that they tend to be quite expensive and are often conflicted. Many investment advisors will charge you 1% per year or more to manage your investment affairs. Brokers will frequently charge even more, costing you 2 or 3% per year in fees. As I suspect we are likely to live in a single-digit investment environment for some time, such high fees will do great harm to your net investment returns. Many investment advisors are also often conflicted. Some will put you into certain funds that give extra kickbacks to the advisors. In other words, the advisors are actually paid to distribute the funds to you. Such funds may not be in your interest, indeed they tend to carry very high expense ratios. If you feel you must get an investment advisor, make sure that advisor is a fee-only advisor. These advisors do not get paid for distributing investment products, and thus are more likely to make decisions that are completely in your interest rather than in their interest. If you feel that selecting a properly diversified set of investment products and rebalancing them over time, as I have suggested on these pages, is too much work, there is a low-cost alternative. I warn you at the outset that the service I am suggesting is one where I am the chief investment officer, and I therefore want to make my own conflict of interest crystal clear. The firm is called Wealthfront. It is the largest and fastest-growing automated investment service. Everything is done online. Wealthfront features a selection of broadly diversified exchange-traded index funds selected to be extremely low cost. The overall investment fee is only 0.25% per year, and all brokerage fees are included. Wealthfront automatically rebalances the portfolio and even offers a tax loss harvesting program. If one of the ETFs in the diversified set of investments in your portfolio has declined, Wealthfront will sell it at a loss and replace it with a similar, but not identical, investment vehicle. Thus, rather than costing you a potentially significant tax bill at the end of the year, as many actively managed funds do, Wealthfront actually can provide you with some capital losses that can be used to offset capital gains or capital gain distributions, and up to a limited amount can be deducted from your tax bill. Wealthfront can be contacted at www.wealthfront.com for more details. Some last reflections on our walk. We are now at the end of our walk. Let's look back for a moment and see where we have been. It is clear that the ability to beat the averages consistently is extremely rare. Neither fundamental analysis of a stock's firm foundation of value nor technical analysis of the market's propensity for building castles in the air can produce reliably superior results. Even the pros must hide their heads in shame when they compare their results with those obtained by the dartboard method of picking stocks. Sensible investment policies for individuals must then be developed in 2 steps. First, it is crucially important to understand the risk-return trade-offs that are available and to tailor your choice of securities to your temperament and requirements. Part 4 provided a careful guide for this part of the walk, including a number of warm-up exercises concerning everything from tax planning to the management of reserve funds and a life cycle guide to portfolio allocations. This chapter has covered the major part of our walk down Wall Street: 3 important steps for buying common stocks. I began by suggesting sensible strategies that are consistent with the existence of reasonably efficient markets. The indexing strategy is the one I recommend most highly. At least the core of every investment portfolio ought to be indexed. I recognized, however, that telling most investors that there is no hope of beating the averages is like telling a 6-year-old that there is no Santa Claus. It takes the zing out of life. For those of you incurably smitten with the speculative bug, who insist on picking individual stocks in an attempt to beat the market, I offered 4 rules. The odds are really stacked against you, but you may just get lucky and win big. I also am very skeptical that you can find investment managers who have some talent for finding those rare $100 bills lying around in the marketplace. Never forget that past records are far from reliable guides to future performance. Investing is a bit like lovemaking. Ultimately, it is really an art, requiring a certain talent and the presence of a mysterious force called luck. Indeed, luck may be 99% responsible for the success of the very few people who have beaten the averages. Although men flatter themselves with their great actions, La Rochefoucauld wrote, they are not so often the result of great design as of chance. The game of investing is like lovemaking in another important respect, too. It's much too much fun to give up. If you have the talent to recognize stocks that have good value, and the art to recognize a story that will catch the fancy of others, it's a great feeling to see the market vindicate you. Even if you are not so lucky, my rules will help you limit your risks and avoid much of the pain that is sometimes involved in the playing. If you know you will either win or at least not lose too much, and if you index at least the core of your portfolio, you will be able to play the game with more satisfaction. At the very least, I hope this book makes the game all the more enjoyable. A final word. One of the most rewarding features for me in writing 11 editions of this book has been the many letters I have received from grateful investors. They tell me how much they have benefited from following the simple advice that has remained the same for over 40 years. Those timeless lessons involve broad diversification, annual rebalancing, using index funds, and staying the course. The first decade of the new millennium was one of the most challenging times for investors. Even a broadly diversified total stock market fund devoted solely to U.S. stocks lost money. But even in this horrible decade, following the timeless lessons I have espoused would have produced satisfactory results. The chart above shows that an investment in the VTSMX, the Vanguard Total Stock Market Fund, did not produce positive returns in the lost decade of the noughties. But suppose an investor diversified her portfolio with the approximate conservative percentages I suggested on page 369 for the aging baby boomers. The diversified portfolio, annually rebalanced, produced a quite satisfactory return even during one of the worst decades investors have ever experienced. And if the investor also used dollar cost averaging to add small amounts to the portfolio consistently over time, the results were even better. If you will follow the simple rules and timeless lessons espoused in this book, you are likely to do just fine, even during the toughest of times. Some discount brokers offer commission-free trading of ETFs. Indeed, when you buy a new closed-end fund at par value plus about 5% for underwriting commissions, not only do you get hit with the equivalent of a large loading fee, but you also run the risk that the fund will sell at a discount at some time in the future. Never buy a closed-end fund at its initial offering price. It will almost invariably turn out to be a bad deal. It may be worth checking, however, to see whether discounts widen in the future during unsettled market. It's finished. Cheers!